All right, so on the agenda today is what we'll be discussing is two decision-making tools. The first one being ROI, or return on investment. And the next one, which sort of works very nicely with ROI, is utility analysis. All right, so today we'll mostly be looking at psychometrics from a selection perspective. However, I'm quite keen on doing looking at utility analysis from a development perspective as well in an upcoming webinar. And if you could, we'll be using a SHRM calculator that's free. You can go to hrcosting.com/HR. This basically saves you from having to try and do some of these calculations by yourself. So what we'll be going through today is just some of the logic, some of the variables that you understand the logic behind it. It's going to ask you to register. All you need to add in is your name, email address, etc. It's free to use, and there's a whole bunch of very, very useful HR related calculators there that you can look into. Also, you'll notice the book being advertised on that website, Investing People, by Wayne Cassio and I can't remember his co-worker now. It's in my references as well. I did use that book quite extensively in the development of this presentation. All right, so let's have a look at some high-level benefits from using selection assessments. The first, most obvious and probably most important one is that you get a better quality of hire. Now, hopefully by the end of this presentation, you will understand how to quantify that. So that you understand how much better quality of hire you actually got. But also you can get saving time in your hiring process. You might get a positive work environment, better fit, and you might reduce turnover as well. Now, these are sort of very high level. The big question is that we'll be answering today is, how do you communicate the above in rands and cents so that your non-HR people understand what you are talking about? All right, so the first tool we'll be looking at is ROI. Now, ROI is a ratio that helps you with decision making. It brings everything back to monetary terms, which makes it fairly simple and easy to understand, easy to communicate as well. And estimate versus actual. So what I'm trying to say here is that you can either do an ROI estimate before the fact, or you can go back and check whether you actually did achieve ROI looking at actual figures after the fact. Okay. Now the formula is actually quite simple. You're looking at ROI equals benefit minus cost over cost. This is, guys, I won't go into more detail than this in terms of formulas. So the goal here is not to be confusing. It is just to follow the logic. So cost is fairly easy to determine in ROI normally. You've got direct and indirect costs, and direct cost is normally pretty straightforward. This is the cost of your assessments, the cost of whatever HR intervention you're busy with. The benefit on the other side, sorry, I just want to go back to cost. It is also important to notice that there is often many indirect costs that might or might not be related. And this is usually a judgment case whether you include it in your calculation or not. The benefit part of ROI is it's usually a little bit harder to determine. Essentially what you need to do is you need to translate whatever the benefits are that you are going to, or that you got from your intervention, and you need to be able to translate that into monetary terms, and that is not always so easy. It might sometimes also require subjective judgment. So if we zoom in on that benefit section of the ROI calculation just for a second, essentially what that is the difference between your before and your after. So for instance, I had X sales before an intervention, then I did something, and now I've got Y sales. So there's a difference. Hopefully it's positive. And you will take that difference and you will essentially divide it by the cost of what it cost to do that intervention, to try and get an example of what is my return on investment? Now, for some jobs, for some positions, some of these positions are easy to quantitate. Something like sales is fairly straightforward. Reduction in accidents, reduction in mistakes, reduction in bad hires. All of these things are stuff that you can fairly easily quantify, and then use that in your ROI calculation. Stuff that's harder is your more qualitative stuff. So, for instance, job satisfaction or many other types of productivity. So, for instance, I might find it very easy to measure the productivity of a salesperson because I'm really just looking at their sales. But how do I determine the productivity and how much it's worth to the company if I look at an actuary or if I look at someone working in accounts? That is a bit harder, but that is essentially what we will be looking at next, and this is exactly where utility analysis comes in. So what is utility analysis? Utility analysis is a framework to guide HR decisions. You compare and choose different strategies, and you choose the ones that maximizes utility to the organization. That could mean that you decide, I've got a selection process with 3 assessments in it and I want to add a 4th one, and it's going to cost me more. Am I going to see benefits from that? Or you can see that in terms of a whole different selection process whereby you add screening assessments and then an interview and then whatever a values assessment or whatever it is. So this will provide you with a tool in which to compare all of these different strategies. Now, ultimately, this ROI equals U for utility over cost. This is where we will get to at the end of the presentation. So ultimately, we're going to be looking at utility analysis now, and then we're going to use it at the end to see how do we translate utility analysis into ROI. For now, with utility analysis, there are 3 main models that we will be looking at. We'll be looking at Taylor and Russell, and there is another one, Naylor and Shine. We won't be looking at that one. And then Brogden, Cronbach, and Glesser, or BCG for short. So we'll be looking at the first one, and we'll be looking at the third one. All right. But first, let's look at some assumptions. One of your first assumptions when you're looking at utility analysis is that people in jobs generate results that have monetary value. Now, like I said, this is very straightforward if you're looking at a sales position. However, you can very easily argue that a company would not pay millions of rands a year to hire a secretary because the returns from that secretary does not justify it. So presumably, if the organization spent more on its staff than what the staff brings into the organization will be out of business very quickly. So even though it's not always easy to quantify, the assumption is that whatever people do has monetary impact on the company. Okay. Second assumption is different people in the same job will produce different results. So if you look at this spread at the bottom, this distribution of productivity, and you imagine that this is all the salespeople in your organization, you would expect to see some kind of a normal distribution there. You would have some star performers, you will have some average performers, and you'll have some poor performers. And I think, and that's not a difficult, I think that's a fairly logical expectation. The third assumption is that job performance or productivity is distributed normally. All right. Cool. So just before we go into the rest of utility analysis, just quickly on job performance. We'll be talking a lot about job performance in the utility analysis formula. What is job performance? Well, it is a multidimensional construct. It is different for a salesperson versus for an executive. And in general, a sort of a well-known model of job performance, it's not the only one, but splits job performance into 2 main high-level factors, which is task factors and contextual factors. So task factors are typically those things that you would, that you would find on a CV and would be able to test whether they can do the job or not. Can they do the tasks in the job description? Contextual factors are stuff outside of that and around that, but it plays just as important a role in that it often includes stuff like your employee citizenship behavior, social stuff. So if task is, if you use the sort of head, hearts, hand analogy, task would be the hands. Contextual stuff is often the hard stuff. All right. So utility analysis, these are some of the variables that we'll get to know through the course of this webinar. The first being the base rate, then the select. I'll be going into detail into each of these. Selection ratio, predictive validity, and using these first three variables, we'll be able to use the Taylor and Russell methodology. Cost is in both. So the cost, you need to be mindful of the cost of whatever you're talking about, cost of selection, and also just from the other side as well, what is the cost of being wrong? Sometimes hiring a person in a call center is might be risky, but it's not as risky as who is your next CEO going to be, right? SDY. SD stands for standard deviation. Y, if you think in terms of an X and Y axis, Y is your dependent variable. That is job performance. That's what you're trying to predict. So if we put that together, how much is one standard deviation of job performance worth in rands? That is something that we'll be looking at. How do you figure that out? Because you need that to perform the BCG formula. And then lastly, the expected tenure. This is just how long people in that position stay on average. Okay. As I go into this as well, we'll be unpacking these shortly now, but also keep in mind that when you are doing a needs analysis with your client, or if you're talking with your client, these become very important questions that you need to also ask, and we'll unpack that in a second. All right, so let's take it step by step. This is your y-axis. This is your criterion, and it is, in this case, job performance. This is what we are trying to predict. Okay. The first thing we'll be looking at is your base rate. Now, anything above your base rate you will accept. Anything below your base rate you won't accept. Your base rate is, how will I explain this? This is how many people are expected to be successful when you are hiring at random. So that might sound complicated, but let me use an example. So at the moment, you've got some selection process for an operational position. Let's keep going with the sales example. So we've got salespeople. Without using any selection process, we've got about 50% salespeople that end up being successful in the job, and we've got 50% of people that end up being not successful in the job. That is without using any selection process. Okay. With certain jobs, think of a street sweeper, for instance. You will, let me just quickly get my drawing tool. For instance, a street sweeper, you will have a base rate down here, which means that a lot of people will be just naturally successful because the job itself is fairly straightforward, and a very small amount of people will fall below the base rate. Okay. In situations like these, it hardly makes sense to use something like psychometric assessments, because the most of the time you will be okay with whoever you hire. On the other side of the spectrum, you can actually also end up with a base rate that is very high, that it becomes very difficult to improve on. So thinking about base rate a little bit differently, for instance, you can say, I currently have a selection process with my salespeople. I just use an interview, and by using an interview, half of the people are successful, other half of the people are not successful. So whatever you want to add in terms of selection, you want to see an improvement, which means essentially the people that you select, if I'm getting half and half with an interview and now I'm adding a GMA assessment, a general mental ability assessment, I end up with, oh, suddenly I've got 70% of my salespeople are successful and 30% are unsuccessful in the position. Okay, so base rate is a very important concept. But let's carry on. Now we're looking at the x-axis. This is your predictor, and your predictor is your whatever instrument or tool or method you are using to figure out whether you want to hire this person or not. So this is your psychometric assessments or your CV checking or your entire battery or process around selection. Okay. And here we're looking at your selection ratio. Now, so that is, if I've got 10 applicants for a job and I can only hire one person, it means I've hired 1 in 10 people, and that is a 10% selection ratio. Okay. So currently in the middle, it means half and half. If I've got 10 people I'm looking at, I'll be hiring 5 people. And wherever your selection ratio is becomes very important in terms of what will actually be useful in adding to your selection battery or not. Okay, so typically, for instance, if your selection ratio, let's just add a little thing here. If your selection ratio sits here and you're rejecting a big portion of the pie and only looking for a small version, then adding something even with a low validity, but with an incremental validity over what you've got currently might be beneficial. And hopefully that makes a bit more sense as we proceed. Okay, let's just move on. All right, so this is what a non-valid predictor would look like. And what I want you to look at are these 4 quadrants. You've got A, this is a hit, your green is your hits. So A is a correct selection. So if you look at over here, no, over here you've got people who are to the right of the selection ratio, so you are hiring them and they are above your base rate, so they are correct selections. If you move down, so you are still selecting them, they are on to the right of your selection ratio, your selection line. However, they're below your base rate. This means it's a false positive. You said, yes, we'll hire you, and they end up not being good in the organization. To the left here, these people fall, you did not select them. They're on the other side of your selection ratio, and they're also below your base rate. These people will correctly be rejected. So this is another hit, correct rejections. And then you've got acceptable base rate. However, we did not end up selecting them as they are to the left side of your selection ratio. So they are false negatives. Okay. So this is what the Taylor and Russell model will give you, and we'll be going through an example shortly using that HR calculator. But essentially what this gives you is a success rate. So you've got A plus B. Sorry, did I write this wrong? Yes, I did. So it's A plus C, sorry, your hits over A plus C plus D plus C plus D. Okay, so that's a little mistake there. That should be your hits, and that gives you your success ratio. And this is what a valid predictor would look like. Okay, so obviously with the shape now being more correlated to a line, so you've got your regression line would be somewhere in the middle here. And this might, for instance, be a 0.5 predictor. This might be a GMA assessment that predicts, that correlates with job performance on a 0.5, so 50%, a 50% correlation. Okay, so it means that you are maximizing your hits and you are minimizing your misses. Okay. So the important thing just to also mention here is that we often think only in terms of the validity of our prediction tools, and that is not the only important thing. Your base rate and your selection ratio makes a big difference in terms of when and when not to use certain assessments. And when you start playing around with those HR calculators, you'll notice that as well. So for instance, when you've got a very, very low selection ratio, meaning only 1%, only, for instance, 10% of people can get hired. Think of your executive positions, for instance. This would be where something like EQ comes in, which compared to GMA is not as high a predictor, However, it adds incremental validity. So it absolutely makes sense to use it in your battery there. Okay. So just a quick revision. This is the variables we've looked at so far. Base rate, the proportion of candidates who would have been successful without the selection process, or your as-is state. So an example, 30% of students succeed without an admission test versus 50% of students succeed with an admission test. Okay. Then your selection ratio, the proportion of applicants selected. That is 1 out of 10 candidates are selected, i.e. 10%. And then your validity coefficient, or R, correlation between predictor and criterion. So for instance, GMA and job performance correlates 0.51 according to Hunter and Schmidt 1998. All right, I did go into this a little bit. So predictive validity and batteries. Here's some general stuff, and most of this stuff is taken from Hunter and Schmidt. I mean, you can absolutely go and read that article again. It talks about utility analysis as well. It's in the references to this presentation. There, okay, you've got an interview, an unstructured interview, the kind of interview most of us use. That correlates about 0.38, job experience in years, 0.18, reference checks, 0.26. Some of your psychometric predictors include GMA, 0.51, which is the strongest predictor overall. Integrity, 0.4, personality, 0.3, EQ ranges from 0.2 to 0.3. So, like I said, remember with stuff like personality and EQ, these become extremely useful when you've got a smaller selection ratio, or when they often talk about within group or between group comparisons. So if you've got a cohort of 5 CEOs applying for a job, and they've got good track record, you can almost assume that all of them are intelligent, and that something like GMA is not really going to differentiate much between them. This is where stuff like personality and EQ shines, because suddenly these are the things that add incremental validity, and you can start seeing that they really determine the differentiation between the different candidates. Also, what we need to mention is that you can't just be summing these validities together and thinking that's going to be accurate. So something like integrity adds a lot of incremental validity over GMA. However, this does not sum 2.92 predictive validity. This, I think, sums, according to Hunter and Schmidt, to 0.68, if I remember correctly. So there's a fair amount of overlap between these methods. Your interviews, for instance, has a very, very big overlap with GMA. Certain personality characteristics also overlap in terms of interviews, etc. So this is really, I've not found, you can use meta studies to start off with, with beginning estimates, but this is where we need to also think in terms of, I'm starting off with an estimate that is predictive validity, but you also need to start thinking about concurrent validity. So actually checking, doing a study saying, okay, I've got the selection process. Let's look at my data now. Let's actually go back and see what of my psychometric batteries predicts job performance in this specific context the best. Because from the meta-analyses, you will get an indication, but your job or your organization or your business unit is going to be different. So there's going to be nuance there. I think I said what I needed to say on this slide. So if you've logged into that hrcosting.com, this is what you'll see. If you click on staffing utility, let me just get my spotlight. Click on staffing utility, Taylor and Russell. You should have a better idea of what these variables mean now. So here I'm saying I've got, let's start at the bottom. I've got a base rate of 0.5, meaning half my candidates were successful, half my candidates were unsuccessful at the starting point. My selection ratio is 0.1, meaning I've got 10 applicants per everyone selected. And now I'm adding a validity sum tool, say for instance a GMA assessment. I'm adding this, I'm giving it a validity estimate of 0.5, and I'm looking at these things and what this draws up, if you think back about that to that graph we just drew, what it is telling you is that with this extra thing, with this extra predictor, combined with your selection ratio and base rate, you're going to be right 84% of the time. So in 84% of the cases, you're going to make a correct decision, which is a 34% increase over the base rate. Okay. So already, even though we don't have any cost calculations in here now, you can start saying to yourself, okay, I moved from a 50% success ratio to an 84% success ratio. It costs me about whatever 300, 400, 500 rand per candidate or whatever it is. Is it worth it to me? Yes or no? Okay. That is what Taylor Russell is going to give to you, is going to give you a hard yes or a no. Two categories, either you are either accepted or not accepted. And this is great because it's very simple to understand, but it can also be a limitation, which is why we are now moving into the next model, which is the BCG model, which will essentially, it moves away from just saying you're either successful or not successful to giving you a rand value for how much more successful you are compared to where you were. Okay. All right. But before we get to BCG, let's look at some considerations. The first is pivotal talent and then talent pool variability. So pivotal talent. It is very, very important to note that not all talent is pivotal. I didn't put the definition in here, but essentially what it boils down to is that if you could increase any job in your organization, if you could increase the productivity with 15%, you will have disproportional impact in certain jobs and not in other jobs. So for instance, if I had a accounts department that was 15% more productive, that would be great for the organization, but it would not be as great for the organization if my executive team was 15% more productive. It's a very big difference. And that really is what pivotal talent boils down to, is saying that given your organizational context, your environment, and your business strategy, certain talent is going to be more important than other talent. Executives are more often than not examples of pivotal talent, which is why you often find these elaborate batteries that would include stuff like integrity and EQ and derailers and whether or not this person can or cannot innovate, etc. I mean, it would not necessarily be justified for other positions, but because the job itself is so much more complex and also strategically important, it often very much justifies the investment in that. So here's an example. For instance, what this is a heat map of your pivotal talent for a example organization. If you look at the bottom here, you'll see your white is your core roles. These are all processes, okay? Core processes, competitive processes, and differentiating processes, meaning it's competitive relative to your competitors, differentiating in terms of your competitors, and it relates directly to your business strategy. So here we've got our directing level. This is your top level. This would be your senior execs. You've got your middle control level. This is your management layer, and execute. This would be your operations. Okay. At the top, these would be different functional areas. And here you can see that there's some positions based on what the organization strategy is. There's some positions that are going to be more important than other positions to get right. These are also the positions where you need to ask yourself the question, what is the cost going to be of actually getting this wrong? Okay. So for instance, here on the execute level, this might be is not necessarily the most expensive talent, but you're going to want to be very selective in this process because you know it is that important to your business strategy. Okay. After sales service, Here you've got merchandise strategy and planning, store, etc. I hope you guys get the idea. This is something that you can map out for your own business unit, your own organization, to try and get an idea of where you want to spend more time in terms of using these kinds of tools that we are showing you now. All right, the next point that we're looking at before we get to BCG is talent pool variability. And just going back to our distribution of productivity. Sometimes, for instance, if you think of someone who makes burgers at McDonald's, that job is fairly straightforward, and it has been standardized to such a point that nearly everyone would be able to do it successfully. There's enough training as well so that everything is standardized, and you're going to find very, very low levels of talent pool variability in that job. Okay. However, as your job level increases, as job complexity increases, as you become more autonomous and you've got more discretion, the positions where you can have these different aspects, typically you find a wider and wider dispersion between your people that are star performers versus your people that are poor performers. And this is important because that means improved selection, or making sure that the organization is more selective, will have bigger payoffs for the organization, essentially. Okay. And this leads us into SDY. Now, we need this in order to do the BCG equation. And what this is, once again, is the standard deviation of your job performance, but in a rand value. So the value of a standard deviation of job performance. And there's 4 techniques that we're going to be looking at on this: the 40% rule, global estimation, and CRIPS. Just going back to this, so SDY means 1 standard deviation above. How much is this worth in terms of rands? If I had a salesperson, my average salary would be 50,000. My top performers bring in more. My poor performers bring in less. Okay. So the 40% rule. This is once again from Hunter and Schmidt, and essentially this is a rule of thumb. This is your most simple, straightforward, easy to use estimation of what SDY is going to be. And the example that they use in the article is, if, for instance, you had a position with an annual salary of $40,000, according to their meta-analysis, you could times that by 0.4 or 40%, and that would give you roughly an estimation of what one standard deviation is worth for that position. So that means your low performance, 1 standard deviation below, this is what they would be worth to the company. 1 standard deviation above, this is what they would be worth to the company. Okay. They also found that for semi-skilled workers, this is roughly 19%. For skilled workers, this is roughly 32%. For your seniors, this is roughly 48%. So here you can also see, as job complexity and job level and autonomy increases, your job variability increases, and that is demonstrated in these figures as well. Okay, but this is a sort of a very quick and dirty way. A little bit more rigorous is the global estimation procedure. This is where you ask experts to estimate the value of performance at the 15th, 50th, and 85th percentile. That is 1 standard deviation below average and 1 standard deviation above. And you ask them calculate the differences between the pairs of percentile estimates. So essentially what you're asking these guys is, what would you be willing to pay if you had to outsource this? So let's use, for instance, the example of a developer. Currently, the organization might be paying whatever, 500,000 Rand a year for a developer. If they asking a panel of experts, how much would you be willing to pay if you had to outsource this and you got in a really star performer, someone at the 85th percentile, meaning he or she is better than 85% of other people in this position. And they will give you a figure and you're going to average that, and they're going to do the same for the one standard deviation below, and you're going to take that figure and you're going to average that, and that's going to give you an indication of how much is one standard deviation worth in rands for this particular position. Okay, that's the global estimation procedure. CREPID is slightly more rigorous than that. And I'm going to read through these points now, and then we're going to look at an example so that you understand, because I don't think it's not, all of this is not necessarily going to make sense as we read through this now. So first off, you identify the individual elements of performance, different tasks. Then you rate importance and frequency of each task. You multiply the average remuneration by relative weight of each element. You rate the individual performance on each element. You multiply performance by the monetary value, and you sum to get a distribution. Okay, let's look at an example so that this becomes a little bit more clear. All right, so looking at number one here, these are your tasks. This is what you're going to list. This is your job spec. This is the stuff that people will be performance managed against. These are the stuff that they need to do well. You're going to then rate the importance. You're going to use some kind of a Likert scale for that. So in this case, it's all rated 5s, all equally important. Then you're going to rate the frequency. And for instance, here, using the example of a nurse, you would, for instance, say that a nurse would, it's really important for a nurse to be very excellent at CPR. However, he or she might only need to use it once a week or maybe even less, hopefully. So that's why frequency is also important. Essentially what you're going to do then, you're going to multiply these together. 3 times 5 equals 15, and you're going to sum it. Okay, that's going to give you the total weight, and you're going to divide each separate task by the total here to give you a relative weight percentage. 15 divided by 56 equals 23.1%. Okay, so this column, your relative weight, should sum to 100. If it doesn't, you made a mistake. Now, say for instance, in this example, this job is worth $50,000 on average. You're going to time 23.1% by $50,000, and that's going to give you a relative dollar value for each task. Okay, so task number 1 is worth $11,550. Okay, that should sum to 50,000, your value over here. If it doesn't, you made a mistake. Now look at the following couple of columns. So these first 2 columns, then your middle 2 columns, and then your right-hand 2 columns. These are your low performers, your performers that meet expectations, and your high performers. And you're going to rate them using a scale of 0 to 2. It doesn't have to be 0 to 2, but if by using a scale from 0 to 2, you're essentially saying that you either can't do the job at all, 0, or you are twice as good as the average performer, 2. Okay, so everyone who meets expectations should get a 1, and you are essentially then finding that this dollar value, you multiply that by the rating there, and that's what you'll get. So for your low performers, for instance, you will be rating, okay, my low performers typically measure 0.5 here, and this is, once again, this would be expert judgment, right? This would be your managers or a panel of talent experts or something like that that's going to rate this. But essentially what you're getting here is you're getting a range. So 0.5, that's going to give you this much value. So we are getting this much value from a low performer versus this much value from a high performer who measured 1.75. And so you carry on down. Okay, and that's going to ultimately lead you to get to the value of what is one standard deviation of job performance for that particular job worth. Okay. Okay, well that's a lot of information. How are we going to use that? First off, we'll be going back to HR costing again. I'm going to show you the example just now. Essentially, these are all estimates, and you're going to use multiple iterations to test your logic to test different strategies, and you can even do sensitivity analyses using this information. And what that means is you're going to make slight adjustments to your different variables, and you're going to see what the implications of those adjustments are in terms of your strategy, so that you can find what is the best solution for your situation. You'll also notice in the HR costing page, we'll see that in a second, that there are additional options for economic factors in multiple cohorts. All this really means is that economic factors, what this takes into account is time value of money and taxes and stuff like that. So we're not going to go into that now. It could be important in your estimation, but for our purposes, I don't think we'll be going into that now. Multiple cohorts is just the idea that there's a kind of a compounding effect in terms of talent. If you do that over time, you've got a compounding effect as you would have in finance. All right, so back to HR costing. Now we're looking at the payoffs from enhanced selection, and we're looking at the BCG equation, that is Brogden, Cronbach, and Glesser utility model. And hopefully now also these variables make sense. So you're going to say validity of the procedure. Your existing procedure is 0.4. So I'm using a interview, and now I'm saying replacement procedure is 0.6. I'm using an EQ assessment, for instance. Cost per applicant of the procedure might be 0 here, and it might be, for argument's sake, 1,000 Rand there. Your selection ratio will be, it doesn't have to be 0.1. I keep on using the 0.1 as an example, but it could be anything. I mean, if you've got 2 roles that you want to place, and you've got 10 applicants, it means a 20% selection ratio, right? The tenure in years of the average selectee, I'll just put 2 in here, but it might be more. For a developer, you'd be glad to get 2, and for a actuary, I don't know, it might be 10 years, who knows. Standard deviation of job performance. This is the important bit that we just spent quite a bit of time now in trying to work this out. And hopefully this makes sense to you now in terms of how the distribution of job performance works. Then the number of people selected in a given year, I just put 2 in here, and here's those 2 points that I mentioned. Economic factors and multiple cohorts. I selected no on each case now, and this is what I get. Total utility 190,000, total utility per selectee, total per year gain in utility per selectee. So you'll see, for instance, because I put tenure of 2 years, that's where this comes from. And because I've selected, number selected is 2, that's why this is more than this. So essentially, if we look at this bottom one, the per year gain in utility per selectee, 47,649. What does this mean? This means you've got a gain in productivity measured in Rand from using the new selection procedure for a year. Okay, so if your figures are right, and this is essentially a Rand, what's the word I'm trying to use? Yeah, anyway. So what Taylor and Russell does, it gives you a success ratio. What BCG gives you how much. And now we bring back the ROI formula again, and we say ROI is utility over cost. I don't have to subtract costs again from utility because it is already included in the formula. So I just have to divide it by the cost. And in this case, I know that I paid 1,000 Rand per person per applicant. There were 10 applicants because I've got a selection ratio of 0.1. So I hired 1 person out of 10 people. So 10 people had to have done the assessment. That's 10,000 Rand. And this is the increase in productivity that I gained, essentially. That is a 476% return on investment. If you had to carry it to the next year, so this figure for 2 years, that becomes a 952% increase in return on investment. Now, this is cool because it allows you to compare different strategies, right? You're going to say, oh, this one gives me 1,000%, and that one gives me, or you can just compare the different rand values. It's great because it provides you with a single figure to compare different strategies with, but it also has quite a big weakness. And the big weakness essentially is the following, is that these kinds of return on investments are going to sound foreign to finance people. They might have a hurdle rate of 14% in their organization, and now you're coming with 1,000% return on investment by using a single assessment. So I would not recommend you use it to say, listen, this is so great, we can spend all of our cash here. That's not necessarily how it works. But you can take them through the logic, and you can use this to demonstrate different options that you've assessed. Okay. So selling overly high ROI or utility estimates is not always easy because it's not, the finance people aren't going to find it credible. It might be absolutely based on credible information. If you look at you just have to think about, making a mistake by hiring a CEO can have huge implications on the organization, but it's hard to quantify. So this is one way in which to do this. Okay. Also, nothing is perfect. So this is a numbers game, right? And essentially what you're trying to do is you're trying to maximize utility for the organization. You're never going to find the perfect thing. You're going to figure out, okay, I've got a success rate of 84%. This is good enough for me. For what I'm paying for, I'm quite happy with what I'm using this for now. Next, I did actually mention predictive and concurrent validity. It is really important. I mean, you're going to start off with some kind of, or you might already be using some kind of an assessment battery. You would want to go and look at, especially for your pivotal positions, you would want to go and say, what is actually predicting most of my job performance? Is there stuff that I need to add because it's not giving me a full picture of what job performance is in this role? Or is there stuff that I can take away because there's clearly overlap between this and that, an interview and a GMA, for instance? So this concurrent validity really can play a big role as well after the fact to really validate your estimates. Another one that I think really is important is this one around holistic thinking. So today we were talking mostly about ROI and the talent and the selection process. However, selection forms part of a wider talent life cycle, and the data that you are creating, or that you're creating by using, for instance, assessments in your selection process, very nicely feeds into onboarding, into management coaching, into mentoring, into development, individual personal development plans for the candidates, etc., etc. And all of that, if you think in terms of ROI there, you are getting more bang for your buck. So this is huge untapped potential in many organizations that we talk to. Lastly, and probably very importantly, especially in South Africa, is the point around adverse impact and bias. If you think back to the Taylor and Russell example, where you had 84% correct estimates, correct decisions around selection for any particular role, you have to be very careful around pushing that value too high, because what you might find is that only the most privileged people end up making the cut, and that's going to leave you with a very undiverse cohort in that job role, which is not necessarily going to look very good, or it might be quite adverse for the company as well. So this is something that you need to be mindful of, that you are playing a numbers game and you're trying to find a nice balance. However, you can't be pushing these models and your methods to perfection, because that also becomes dangerous. Guys, and I think that's it. I think that's my talk today. Thank you very much. Are there any questions?